like that you brought up meme coins earlier, because I think the dynamic is really similar. It trades off of momentum and speculation and loser, or just passing off the bag to the next guy kind of theory. But some of these can go for a really long time. I mean, like if you take, for example, Dogecoin, right? It's a cryptocurrency where the supply cap isn't limited.
Right.
You can create infinite Dogecoin, but still it's the 8th largest market cap of all cryptocurrencies. So some of these things can go a remarkably long time.
Timing is one of these things that, I mean, I'm a little bit different from my peers where I don't think that timing is something you can do in markets. And a lot of my peers roll their eyes and they're like, no, we got to try anyway. And sometimes like we were short this stock 𝗤𝗏. 𝗤𝗏 was this like fake biotech thing. I'm a biotech expert, obviously. And it was very clear to me. I even wrote a paper on it. You can read it on The Impossible. I wrote a 40-page paper about why 𝗤𝗏 the drug cannot work for Alzheimer's. It's impossible that it would work. And rarely do you get to say something like that in medicine. On The Impossible has 2 papers on it, not 200. Because it's rare that you get to put your foot down and say, no, this drug will not work. And I've seen thousands of drugs. And I've seen maybe 10 or 20 in my life where I could have that much confidence. And I feel like, the confidence for me on D-Wave and quantum computing is very, very high. But to your point, I mean, when will the trade work is a whole other question. I've tended to avoid that in my career because I generally find that variable, you can call it lambda or something, that is distributed in a relatively just even distribution. It's normally distributed. So sometimes I'm early, sometimes I'm late, sometimes I'm right on time and I feel like a genius and I time the market, but mostly it's an illusion. And, because the market is not whispering to you, oh, there's a lot of momentum right now. There's a lot of crazy, liquidity right now, and it's all going to go to this stock. Nobody gives me that whisper. I try to divine it, of course. I see 𝗏𝗏 up a lot. So like, it's very hard. There's this stochasticity to the market. It's undeniable, right? And like your job, I think, is just to survive. And if you can survive, generally you can profit. And obviously, like I took this very big position in D-Wave and I'm paying the price for it, which is crimping my liquidity. It may mean that I have to get out of the trade or reduce it. It may mean that I have to add more capital to my account, like all stuff you don't want to ever have to do. But we also praise irrationality while we bash it, right? When you're in the position, you say, I need the market to be rational ASAP. But when you're not in the position, you say, I want the market to be as irrational as possible. I want 𝗏𝗏 to be at 10 billion. I want Doge to be at 100 billion. And then I can scalp it really easy. But of course, rationality is not some function of when you enter. Rationality is generally, honestly, I think a function of liquidity drying up. So Doge is one of the funniest examples because it's a mystery to people. Dogecoin is not a meme that's like relevant or important. Like memes move quickly, but it has this weird staying power. Some people think Elon is like oddly behind it or some other explanation that is the reason for Doge persisting despite it not doing anything. And obviously, like you said, it has some technical flaws, but even things like Cardano and things like, nobody uses Cardano and Cardano is worth billions. And, Ripple is another example. Ripple's worth 100 billion and it's useless. So I think that sometimes we tend to measure the timeframes in days and weeks because we have to look at our P&L like that. But I would, and I can't cash this bet in, but I would say that in 50 years, there is no Cardano, there is no Doge. We look at Cardano in a split second, instantaneous time, and we say, no way this thing could be worth this much. And then we look at it in a month and we say, wow, it's still worth this much. It's crazy. The market's so stupid. I think if we look at 5 years or 10 years, we say, okay, now maybe is there something to this or something like that? But the reality is like, you're right. Doge has been around for 10 years and it still hasn't died. But what if it dies tomorrow? Nobody would be like, oh my God, I can't believe Doge is gone. They're going to say, oh man, Doge lived past its time. Like, I'm not surprised it went down 50% or 90% and never came back. They would say, yeah, we could all see this coming. It's Dogecoin after all. And we don't know what the liquidity situation is behind the holders of Dogecoin. God only knows. Maybe Elon one day gets a margin call and says he has to sell his 3 billion Doge. And he was the one, perking it up all along. There was a famous story. I worked at this so-called Tiger Cub called Intrepid. Tiger was this big hedge fund that was sort of known for its bold, intrepid moves where it would short a stock if it believed in the short and just never cover. And so the Bank of Sumitomo had a rogue trader. You guys know what a rogue trader is. A rogue trader is a guy that works at the bank or a brokerage or a fund or whatever, and he's secretly putting in orders that he's not allowed or authorized to make. So this guy, Bank of Sumitomo, he's in Japan, he's buying the world's copper supply. Nobody knows, only him. These big banks are so disorganized that you could actually do that. There's a guy that did this at SocGen, Société Générale, the French bank, named 𝗍𝗂𝗃𝗏. There's a very famous trade. He put $6 billion position on without telling anybody. He just found a way to do it. He just picked up the phone and said, this is Jerome from SocGen. I need you to buy $100 million of spiders. And the other guy was like, okay, here you go. And so he kept doing that and it worked. And, nobody caught up to it until they did an audit. Well, this was what happened in the 80s with copper. Bank of Sumitomo kept buying copper and Tiger kept shorting it. And they said, I don't know, why is it going up? It doesn't make any sense. Copper is not worth this much. And they kept shorting it. And it wasn't a commodities rally like the other commodities weren't doing great. So it was so aberrant and bizarre. And they kept shorting. And eventually they arrested. Tiger didn't have any idea what was happening in Sumitomo, but they eventually arrested the guy at Sumitomo. The Bank of Sumitomo sold all their copper. They said, we are not supposed to own half of the world's copper. And they dumped it all. And Tiger finally either broke even or made some money. But again, the other positions, made Tiger a really successful hedge fund. They had cassava-like shorts and also great longs too. And you could take the pain on one stock if you're making money on the other ones. And I think that's something that's really important, is that you don't overextend yourself if you haven't built up this nice profit cushion. I've built up a nice profit cushion. I can take some pain on D-Wave because I know it's going to end up like cassava. Now, I could be wrong, and I'm not going to have to lick my wounds and, retreat into my, convalescence for a while. But the reality is I think I'm going to be right, and we'll sort of see how it plays out. But I fully agree with you and understand, this is the paradox of the market. Irrationality gives us our profits, but it also gives us the pain of waiting for them to become profits.
Let me ask you this, though. In your honest opinion, I know nobody has a crystal ball and you can't predict the future, but based off of the current price action and your previous experience with shorts, how long do you think this bubble realistically could last, in your honest opinion? I know you can't.
Yeah, I all my opinions are honest, and I would tell you that I did a chart, I did a table of all of the bubbles I can think of and how long it took for those bubbles to go down. And what was fascinating is I psychologically remember the bubbles popping very quickly. But the reality of the data was they take forever to pop. Much longer than I thought. Not forever. They take about a year on average to pop from their peak. And when I say pop, I did all kinds of statistics on how long did it take for it to drop 50%, how long did it take to drop 75%, 90%, etc. And there was a shipping bubble. If anybody remembers dry shipping and some of these other stocks, there was a huge shipping bubble. There was all these little micro bubbles. And then there was big bubbles in subprime and big bubbles in .com, big bubbles in tulips, big bubbles for centuries. Ever since there have been markets, there have been bubbles. So they take forever to pop. And I think the answer is I don't know. But the answer is also you have to be prepared for the stocks to drop 90% tomorrow, the stocks to drop 20% tomorrow, the stocks to stay flat for 6 months or any other arbitrary number of time. And you have to be prepared for the stocks to jump 50% or 100% or 300%. I don't think you can know. But you have to be prepared for a generally wide distribution of possibilities, including multiple X's up. Now, somebody would say, if you think there's going to be multiple X's up, you would buy it. Of course I would, yes. But I don't think that's going to happen, but I have to be prepared for it anyway. I don't think my house will catch fire tomorrow, but I still have a smoke alarm. So I think that by having a 5% position, let's say it goes up 3X, I survive. Do I want to short more? Well, I might not have the choice. I don't have the capital, but I maybe could short a little bit more. But if it goes up 5X, I'm really going to feel it. If it goes up 50X, I'm out of business. So I can't survive that wide of a distribution. Now, the thing about longs and shorts is nobody can survive a long enough distribution unless you don't use leverage at all, you don't short at all, and you are very diversified, because otherwise you could survive like nobody could survive a relatively permanent loss of capital unless they have some amount of skill. And, like I said, we shorted cassava, we shorted galactic, we shorted humuside. We had a couple of good trades in the last six to 12 months. So I'm very happy to sort of, take a little pain. Any amount of pain is more than I want. But I also recognize that like markets have stochasticity. They don't become rational when you snap your fingers, even though you want them to. The second you buy an undervalued stock, you hope that private equity takes it over for 50% premium. The second you short a stock, you hope Muddy Waters comes out and writes a short report, and the stock drops, or, the SEC arrests the CEO and the stock drops 90%. That's what we hope. But reality, unfortunately, does not comply with that. You have psychologically, kind of people searching for dopamine rush. They want to buy a stock. Look at the stock. It's up 30%. If I bought on a margin, I'd be up 60%. If I bought calls, I'd be up 600%. How else am I going to get myself into financial freedom? But if I have $50,000 and I 600% my account, I can quit my job, and et cetera, et cetera. These are the kinds of things that go through people's minds when they buy a stock like this. And it becomes a self-fulfilling prophecy until it all kind of comes crashing down on a lack of fundamentals. There's not been a next Bitcoin. And in fact, if anything, like Ethereum and these other kind of like second run cryptos have kind of like, if anything, fallen, and Bitcoin dominance has been increasing. Because I think
Solana and Ethereum are scam technology.
Yeah. So like ultimately what ends up happening is, this is why like the majority wealthy investors are fundamental value investors, is because ultimately you have to look at the earnings. All the momentum, all the psychology cannot provide the substance. The substance is, I sell a product, my customers love my product. When Sam Altman buys $10 billion of NVIDIA chips, he thinks he can make hundreds of billions with them. When Elon Musk buys $10 billion of NVIDIA chips, he thinks the same thing. Nobody's buying the quantum chips thinking that they're making any money. One company is buying, one institute, not for profit, bought one computer from D-Wave. That's the one computer they sold in 5 years. They're buying it to study it and to write papers about it. They're not buying it because they think that it's going to be something useful and profitable. They're buying it because it's cool. Now, could these work someday? Yes. Could they be useful someday even? Maybe. When is someday, and how useful is useful? And those are the things that are the questions that I'm, again, skeptical of. They may be proven out a long time from now. And in the meantime, speculators will run rampant. But speculators get bored, and they ultimately have to ask themselves, what are the earnings? Because NVIDIA sales, they've gone from, I looked at their revenue yesterday over the long run. They were about $1 billion. Then they went to 5 or 6 billion. They hung out there for about a decade. Then they went to 10 billion, 20 billion, 50 billion. They might do 250 billion in revenue next year. $250 billion of revenue. That's a real company that's selling real products that people love. Bitcoin
Went from 50 billion to 250 in a year.
They are, we'll see what they do this year, but they about 3x their revenue twice in the last few years. Let me give you the exact number. I'm skipping years there, but 250 is the estimate for 27, 200 is the estimate for 26, and 130 is what they just did. These are fiscal years, so they just did 130. Let me maybe make it easier and give you the last 3 years. 27, 61, 131, and now they're expecting 200. So from 27 billion to 200 billion in just a couple of years. That's a successful company. They have a great product. People love their product. Their customers fight to get their product. These other companies, again, IBM gives away their quantum cloud. They give you 10 minutes of free time every month. And even then, I can tell by looking at the queues, nobody's using these computers. For IonQ on AWS, I predict that almost all of IonQ's usage on AWS comes from me personally. Nobody wants to use these computers for anything. They don't do anything. As I mentioned earlier.
A good way to predict future growth for like all these industries like AI, blockchain, quantum computing, etc. is the amount of academic research that's being done on a year-over-year basis. So like if you look at
very interesting
research,
it's pretty flat, like over the past 10 years. And if you look at AI, it's gone pretty much exponential.
Parabolic, yeah. That's a fast. I've never once in my life. I've read academic research since I was a baby, practically. I never thought. I've graphed it for various things, but I never really connected the dots of graphing them as a future indicator. But I really like that. And quantum research has actually gone the other direction, where, you're telling me they're flat, which I believe is true. But if you talk to like the really smart people out there who are like the newest, freshest grads at the best schools, they do not want to be in quantum. That's like, if you told like me, somebody at MIT is like, I want to do quantum computing, a top, like the valedictorian or something, everyone would look at that person like they're crazy. Like, well, this is like a dead field. Nobody wants to be in quantum because it's just not that interesting. It's an interest. AI is interesting. Deep learning is interesting. Robotics is interesting. Nobody wants to be in quantum because there hasn't been any movement in the field in a decade. And even IBM, one of my favorite data points on my short here is IBM quietly, completely scuttled their plans for the next 2 years in quantum. They used to have, and you can find this on the Wayback Machine very easily. The Wayback Machine doesn't have like really old stuff, but for the last like 5 or 10 years, they have like every day archived to these websites. So if you go on the Wayback Machine, you'll see IBM said that they would have a 1,000 qubit machine this year and a 10,000 qubit machine next year. That's a lot of qubits. They've completely taken that off their website. They are not planning on doing that anymore. They want to focus on what I was saying earlier, which is gate fidelity, getting that up to 99.99 or 99.999 or more. Every nine is one step closer to where we need to get to. But again, to what end? What do you want to do with these things? I want to factor prime so I can do what's called the discrete logarithm problem on elliptic curve cryptography and hack Bitcoin. That's my goal. That's why I'm so interested in these machines. They're fascinating scientifically, but they're also quite interesting from the Bitcoin perspective. I don't want to steal Bitcoin or anything.
How do you think it could affect ransomware from both offense and defense?
Yeah, I was going to say it kind of is good from a defense perspective, right? Because it's a tool to say, I can crack any ransomware. But the NSA has like, again, what you want to believe about NSA is up to you. But NSA has already done the work on this, legitimate work on this, which is they created 2 post-quantum PQC, post-quantum frameworks. One is called dilithium. The other one's called Kyber. They work on different types of math that are not...
Yeah, I think Apple already put one in iOS.
Exactly. Like, you can already defeat quantum today. So the idea that I have to wait 20 or 30 years before I can beat RSA, well, in 20 or 30 years, yeah, I still probably would want a list of spies that live in my country or something if I'm NSA. But it's really not that interesting. 20 or 30 years from now, we'll already have moved to Kyber. We've already have moved to dilithium, lattice-based cryptography, other areas that are quantum resistant. So why, why the excitement? And it's mostly, it's like a tradition in technology where people get more excited about what they don't understand more than what they practically do. So like AI is a good example. I have my friend Yaroslav's here's a top AI guy, worked at all the top AI companies. There's this mystique around this from investors. Investors want a lot of times what they don't even understand and what's just so emergent that nobody understands it. And a great example is SSI. This is a company called Safe Superintelligence. They have a brilliant guy who's running the company, many brilliant people who work there, but it's a brand new AI company and it's worth $10 billion or more. I think they're going to raise money.
Worth 40 now.
Yeah, they're going to raise money at 40. They don't have a product. They say they're not putting a product out anytime soon, but they have a brilliant group of AI researchers, and that's great. But as reality starts to dawn, companies get a lot more boring.
Do you think they have anything proprietary right now?
Listen, this is
absolute crack engineers.
It's a lot of rumors and there's a lot of stuff. There's some people who say yes, some people who say no. But point being that when you have something that sounds amazing, CRISPR is maybe my best example here. So I'm a biotech guy, as you guys know. CRISPR sounded incredible. Wow, imagine being able to edit the genome. This sounds amazing. CRISPR stocks peaked at the exact time of the most uncertainty about how you could use CRISPR. They did not peak when the technology became more tangible. When the technology became more tangible, the people in biopharma said, oh, this is actually a lot more boring than we thought. Turns out that we can only CRISPR certain things. Turns out if we do want to CRISPR lots of things, we have to use, conditioning regimens, which are basically chemotherapy. It turns out CRISPR is just not that cool. And it sounded better when it was science fiction. And quantum's sort of the same thing, and many other things turn out to be the same thing, where even AI sometimes, there are a lot of people predicting the death of AI, where we're not going to quite return to the disappointment of expert systems of the 80s, but there's a little bit of this wonder about, have LLMs topped out? Are we at this place where we're going to get this awesome chatbot that's really smart, but that's it? What you see is what you get.
LLMs may have stopped up, but the idea of AI, that doesn't even make sense.
I agree. It's probably never going to top out. But I guess from the perspective of, let's just like very practically, will ChatGPT 5, the distance between GPT 5 or ChatGPT 5 and GPT 4 be bigger than the difference between 4 and 3 and 3 and 2 and 2 and 1? It seems to some people, I don't necessarily agree with this, but some people believe that maybe that distance is going to get smaller and smaller. I don't know. But I think that is what, is concerning some people, that, okay, is this all we're going to get out of AI, or is there going to be another quantum leap someday? And of course, someday, of course there will be, but is it coming soon, or are we stuck now in a new local minima where, we got LLMs, really cool, but we more or less have trained the whole internet, and synthetic data and all these other techniques. And this is it. This is what we get for the next 10, 20 years. And that would be a huge W, right? Like, there's nothing wrong with that. This is one of the most amazing technologies ever, but we want more. And the reality is we're now starting to turn our eyes, especially if those deltas get smaller, we're going to start to turn our eyes to things like revenue, users, earnings, costs, like the boring stuff. And investors hate, because, you actually have to realize the dream is over. It's now about basic business, and what's the basic business look like? And it usually looks a little bit different from the dream. Sometimes, you get a business miracle, but oftentimes the dream of the investor, the changing the world, and the reality look totally different. And, Uber is an example of a company that kind of delivered on both, but there are many companies that tried to be Uber and didn't. Telehealth is another good example where, like, Hims has been like the sole success story. Everyone else has bombed out, and the thesis makes so much sense. And you can just hear the pitches of the young, eager students going to the A16Zs and Sequoias and saying, healthcare has been a big waste until now. We're going to optimize the world's most, inefficient market. And a guy unveils the app, and it's like, wow, this is going to be the next, Facebook. And they invest, and it turns out that revenue topped out at 30 million, and it's low gross margin. It's a dud, So I think that most of the technology kind of ends that way. And quantum is, I think, not going to be any different. We're talking about AI and blockchain, like different levels of success and different levels of use case and usefulness. And I feel like, again, the one thing going for the quantum bulls is that these market caps aren't that high yet, right? And I think we're in this new normal of liquidity where there's
volatility is what brings the traders in.
Right. But also market cap's important, because I think crypto showed us that maybe it's not as important as the stock guys think, but the stock guys, at least, I would say that the market cap is the ultimate magnet, or the gravity force, where it's like, look, after enough billions in market cap, both the shareholders and the short sellers and just the market in general start to say, nah, I'm not going to let D-Wave become a $25 billion company. I'm going to sell it. I'm going to short it. The founders that own 1 or 2% are going to say, I'm out of here. I just made 250 million. The IonQ guy, the IonQ CEO, quit and sold all of his stock, and he sold 40 million worth. And everyone asked him, what are you doing with the 40 million? He's buying a house. He decided a house is way bigger to him than the quantum computing revolution, So I feel like, there's market forces like that where, whether the market gets it today or tomorrow, they'll eventually sort of figure it out and move on. So yeah, I'm down a few million on the trade, and it's very painful, but I have a few choices. I can liquidate everything I have and just go crazy on it. I can even, you can even go further than that. I can go raise a hedge fund that just shorts these stocks and raise $100 million or something like that. I don't know how much I could raise. Maybe 100, maybe more, who knows? And just literally make this the biggest bet I've ever done. Or I could be more reasonable and just sort of like, okay, I'm going to write out my position that I have. If it gets into the black someday, great. If it stays in the red, it is what it is. But I will say that as it goes up, I have to find capital to sustain the trade. And nobody wants to do that, right? Because your P&L is red and your buying power drops and you have to keep adding money to sustain yourself. So at $30 or 40 or 50, you're sitting there saying, okay, I'm putting more money into this trade because I'm just trying to survive the trade. And when it goes back down, I'm only going to be recouping some losses. I'm not going to be making money. To make money, the thing has to go to like single digits. It is one of these things where adding to it is like, takes a lot of guts. And I'm considering doing it. I've added a small amount, but like at this point, I'd really have to start thinking hard about like, do I really want to be all in on one stupid stock that could still double again? And I think if
you martingale this, you can't lose. If you have potentially, enough leverage, you can't lose if you martingale this. It's going to go down eventually.
GameStop, they said that about GameStop and Melvin, I don't know Gabe well, but Gabe worked at Tiger Cub as well. And
I don't think martingale works with shorting.
So Gabe worked at a Tiger Cub called North Sound, which I was close to, and Gabe went to SAC. North Sound kind of wound down a little bit. And then at SAC, he was one of Stevie's best traders. So he had one of the biggest portfolios at what's now called Point72. And he started his own firm, Melvin. Melvin, did really well. He got more capital. People were fighting to put capital into Melvin. We all know what happened next. The GameStop trade happened. And the question became, what's he going to do? And Steve Cohen's got pretty deep pockets, and so does Ken Griffin. And they both wanted Gabe. He's super talented. He's a really good stock picker. But he got caught in basically a 200 sigma event. GameStop there's never been anything like it before. And I've seen it all. And it makes every other short squeeze look pitiful. And so it happened. And both guys, Steve and Ken, were willing to give him a couple billion apiece to bail him out and stay in the trade. Because they said the same thing. This company is useless. It doesn't make any money. GameStop is the whole asset. Nobody disagrees. Even the CEO of GameStop, I don't think, disagrees. The whole thing's maybe worth $500 million, $1 billion at tops. So when it traded for, $100 billion or something, they said this is ridiculous. This is, you wait yourself out of this, etc. But the problem became everyone knows you're in this trade, Melvin. Everyone knows you're in this pain. We're just going to keep squeezing it until you exit, and you're the exit liquidity for the squeezers. Now, you can see how that ended back to $20, down 95% from the top. So everyone loses. The longs lost, the shorts lost. It's just chaos.
So was he forced out of that position?
Yes. So
I guess it depends on what your starting position is when you're doubling down like that.
Exactly.
For sure.
Exactly. And if you can raise more capital, that's kind of the secret weapon, because there's a lot of smart investors out there. And if you scale all the way up to like, okay, I'm going to go to Adia and Audic. These are the investment firms of Abu Dhabi, the state of the country. And you go to them and you say, okay, I have you have a good relationship. You made the money in the past. You say, I need $5 billion to short these stocks. They might do it and say, okay, go ahead. Here you go. You made us money before, Martin, or whoever it is, Gabe. Here's another $5 billion and go to town. And, you can raise the capital, do that. It's great. What typically happens in both hedge funds and personally is that your capital position is dropping as you're losing money. And personally, of course, your buying power and capital position are dropping. In hedge funds, it's even worse, where your capital position is dropping and, your investors want their money back. So if you're in Melvin, you're sitting there saying, okay, let me get this straight. I put money in this fund. It went up 20% a year for 6 years, made a lot of money. And now almost all of it's gone because of this one stock. And at this rate, all my profits are gone. But soon all my capital is going to be gone if I don't take my money out. I'm going to put in a request to take my money out at the soonest available time. And that means that he has to get out of the trade because he doesn't have capital left. So being in a hedge fund makes it 100 times harder to sustain these. And the only people that really want to short are a couple of crazy individuals. Most individuals are long and often leveraged and even leveraged with options. And hedge funds that are very sensitive to not being Melvin. You know, the hedge fund world now, the Citadels, the 𝗤𝗓𝗏𝗍𝗍s, the .72s, I take nothing away from them. They're fantastic firms. They are very, very, very risk averse to shorts. And if your short goes up, the risk manager taps you on the shoulder, or the portfolio manager before that, and says, you know, we're out. We can't sustain the short. It's too scary. It's too dangerous. And this kind of creates this like rocket fuel for longs in a way. But again, it all tends to crash on itself when reality shows up and reality says, what are the earnings of this company again? Why would I buy this company that has no earnings for $4 billion when I could buy a real company for $4 billion? And again, if you ever have to do the reality check, you just basically say, would you rather own all of the shares of D-Wave or 15 well-known skyscrapers in Manhattan, which you could buy also for $4 billion? And what would you leave to your kids? 14 skyscrapers or shares of a company that are all of the shares of a company that, you know, look not so great, but the stock has been hot. You know, needless to say, everybody would say, give me the 15 buildings that have been here for 100 years. These are really valuable core real estate holdings in Manhattan, the best city in the world. I'd rather take that, or $4 billion of S&P 500 stocks, or a sports team like the Cowboys, probably worth about $4 billion. These are the kinds of assets that I'd rather have than D-Wave. And it really doesn't take, the funny thing about investing is, you know, it doesn't take the brain power of a brilliant computer programmer or a great entrepreneur. Nobody is not smart enough to see that this company is in shambles and kind of a scam. But the price is the tantalizing, you know, kind of siren singing to you and lulling you into this belief that, oh, this is exciting. And that siren is very hard to ignore sometimes.